Welcome to another Wall Street Informer production on WSI TV.
Welcome into another episode of our Weekend Winddown edition of WSI TV. I'm Jordan Bishop. I'm here today with Sean Bauer.
Good morning.
And we've got a very interesting episode for you today. There's a lot going on this week, isn't there, Sean?
Yeah, it's a really big week ahead, especially for, well, I guess the economy as a whole. But we have the Federal Reserve and Chairwoman Janet Yellen deciding whether or not they want to raise interest rates this week, Jordan.
Yeah, definitely. And that decision should come out between Tuesday and Wednesday. I know that's when she's meeting, and she's planning on talking about it. But you know, there's a lot of people out there who question what this means for their finances, if it means anything for their finances. I mean, it absolutely does mean something to everybody's finances. It's something you should definitely be looking out for, especially if you've got a retirement account or if you're looking for a loan on a house. You know, it affects absolutely everything.
Yeah, pretty much everything, no matter what you're talking about, whether it's real estate, stocks, the economy in general.
Right. Consumer spending's affected. You know,
absolutely, of course.
As you said, we expect for her to raise them on Wednesday, probably not by too much.
Yeah, it should be another really small raise. It's just been 0.25% this past couple times.
Right.
That should be the same thing as we expect. And again, the market is pricing that in almost entirely now.
Yeah, definitely. You know, really, a raise could help stabilize the market, could help kind of tame the wild action that we've seen.
Yeah, it's been flying since November, so.
Right, and we're in sort of like a weird place right now. If we look at Europe, the European Central Bank released their decision on their rates on Friday, and they didn't touch it. They're still at 0%. Which
it's a very interesting contrast now with, they're still at 0. We're now raising again. We're really just getting started. Just we're all on the same page. We're still very, very low interest rate wise. But we are starting to raise rates while Europe isn't. It's a very interesting disparity there.
Yeah, and Europe's playing it off as if it's like an asset plus environment for the economy. They want people to be buying assets now while they've got very low interest rates, most of the time 0 interest rates on loans they take out. And it's weird because when Trump came into office, he sort of slated Yellen and said you should have been raising them regularly since the crash of 08-09, and we could see some very devastating side effects from the interest rate being so low at the moment.
Yeah, it's been at 0 since we saw the 08 crash. The Federal Reserve has actually artificially kept it low, down at 0.
Right.
And it's, the general idea of keeping rates low is that people want to spend more.
Right.
They can borrow more so they can spend more.
Exactly.
That sort of thing. Maybe politics played a part. If you've been with us, all last year we were kind of commentating on how the Fed was probably keeping rates down at 0 because they were trying to keep the market propped up a little bit to hopefully usher in another wave of the Democratic Party in the White House. Now, as we sort of predicted, since that race is over, there's a Republican in the White House, the Fed, led by the Democratic Janet Yellen, is ready to just rip rates.
Right.
And we're sort of getting started with that now.
Yeah, and it's almost becoming, or has already become, you could say, spiteful politics.
Sure.
Is she raising them for the good of the country, or is she backtracking now that because they haven't raised them too much in the past 10 years or so?
Yeah.
Is she looking to make up ground? Which, realistically, going into recession, you want the interest rates to be around 300 points.
300 points, right?
Basically, because when going into a recession, if you have a high interest rate or higher than where we are now, the Fed can then cut the interest rates in half, and then it helps the economy gradually get out of the recession.
At that point, you're trying to boost spending from consumers, just from citizens, by cutting the rates.
Right.
But you need them to be up there in the first place to be able to get out of that recession. A recession that it looks like we may be heading towards right now.
Exactly. If you picture the economy like a fully functioning car, it eventually runs out of oil and the engine seizes up. Now, when you're in a recession, you've got no oil. Financial spending is not money isn't circulating too well. So by cutting those rates, it entices people to go take out loans to help pull themselves out of that financial recession that they are in, as well as the economy. So it's a big deal. We are where we are now, and we expect her to raise them, but we should realistically be in a different position if it would have been handled a little better over the past few years.
That's absolutely right. And spiteful is probably the correct word, going back over the year plus that we've been in. But yeah, just to put that in perspective, 300 points is what you're looking to cut to get out of a recession. We're at, I think, 50 going to 75 points now. So just so you know, we're still very, very low, as we keep mentioning.
Right, but that's not to say that you can't make some strong financial gains in this market right now, because even if the rates go up to 75 or 100 even, it's still a great real estate market. It's still you can still get a fantastic rate on a loan.
Exactly.
It's still a very heavy consumer spending economy at the moment. So all this talk about the recession, it's all speculation. We'll be here for you if things do start to slide. But just be mindful of how this really affects your finances, how you can kind of regroup and take a grasp of your own financial being.
Yeah, absolutely. And as far as the market itself is concerned, I think it's important to note that the economy and the stock market are not the same thing.
No.
They often correlate, they go hand in hand a lot of times, but they're not the same thing. And kind of one of the worries about raising rates is that now as you raise rates and they get higher and higher, as they should continue to do, if the market still seems okay as far as the Fed is concerned, as rates get higher and higher, it's easier for consumers to make more money on some safer, quote unquote, safer, less speculative investments than the stock market. Because whenever rates are at zero, the only real way to have your money grow is through investing in stocks. And most people don't have any real idea about how to invest correctly or intelligently. So that's whenever this could start biting people in the butt, they're actually closing out these stock market positions. That's one worry for the stock market, is that now we don't have as much buying power, I should say, Jordan.
Exactly, yeah, that's exactly right. And we want you to keep all this in mind as you go forward with your investments. And if you have a comment, you got any questions for us, comment in the boxes below, and let us know if you liked it by giving us a thumbs up and subscribe to our channel. Thank you for being here with me, Sean.
Absolutely.
We'll see you next week.
All right.
Thanks for watching another Wall Street Informer production on WSI TV. Be sure to visit wallstreetinformer.com, where you can become a member for free and gain instant access to the secrets of market millionaires via the Wall Street Informer Vault. So go ahead and claim this gift for free now at wallstreetinformer.com.